Hey everybody, welcome back to the Optometry Money Podcast, where I'm helping ODs all over the country make better and better decisions around their money, career, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors. Thank you so much for listening again today. And in today's episode, I have another great guest. It is May, which, as all of you probably know, it means that it's Disability Insurance Awareness Month. And if you're wondering, yes, it's totally a made-up awareness month, probably by the insurance industry, but that's okay. That's okay because it gives me a reason to talk with you today about something that I feel is important to any optometrist's financial plan, and that's disability insurance. And instead of talking for a whole 30 minutes about insurance by myself, cue the collective sigh of relief, I wanted to bring on someone who works in income protection day in, day out. So I'm happy to have David Bennis on the show, an income protection consultant with Truluma. And I don't have any direct affiliation with David or Truluma, but I've been connected with him for many, many years now, since my earliest years in the profession when I actually did sell insurance. He's full of stories and metaphors and analogies, and clearly has so many years of experience here. And we talk about what disability insurance is and what it does, and give the case sort of for why it's important. Then we dive into all the different features and bells and whistles to think about when it comes to looking at a disability insurance policy. And towards the end, we go over what practice owners should be thinking about for different disability coverages special to them as owners. And I know, listener, I know, insurance is not the most exciting thing to hear about or to think about or to plan around. I feel you. I get you. And while I own a commission-free financial planning firm, I still think insurance and risk management is a super important part of your planning. And hopefully we didn't lay it on too thick during the conversation. But if we did, sorry about that. If you have any questions on today's topic, you can reach out to me at Evon, E-V-O-N, at optometrywealth.com. Lastly, if you did want to learn more about me or Optometry Wealth Advisors and how I'm helping ODs master cash flow, proactively tackle taxes, and build their net worth, just plan more purposely with your money and your practices, take a look at my website, optometrywealth.com. With that, here's my conversation with David Bennis. Hey everybody, welcome back to the Optometry Money Podcast. I am your host, Evon Mendrin, and in today's episode, we are going to talk all about income protection from disability. And to help me through that conversation, I have another great guest, and I'd love to welcome to the show David Bennis, a consultant with Truluma. David, thank you so much for coming on.
Thank you for having me.
Yeah, of course, and I'm happy I was able to get you on, someone that lives and breathes income protection day in and day out, because this admittedly is not the most exciting topic for many optometrists to think through on their own, let alone plan around. But it's important. Managing financial risks in your life is super important, and being able to plan for or plan against and manage the big risks in your life is what really allows you and gives you the freedom to focus more on the things that are about investing and wealth building and building practices and buying houses and doing a lot of those more exciting things in your life, when you know you have that peace of mind that you've taken care of the big risks that can come up from behind you. So I'm excited to chat with you today about this. And before we sort of dive into a lot of the nitty gritty here, give us a little bit of a background. You and I actually go back years, in my earliest years in the profession, to when I actually sold disability insurance, among other things. And so how did you get into that world, and what are you doing now?
All right. So a little bit of background here. I've been in the business for over 20 years now. Started off as a life insurance agent, financial planner. And quite honestly, no one ever talked to me about an income protection program. And finally, one day, someone approached me and said, "Hey, what is your most valuable asset?" I don't know, my house, I guess, my retirement. And then they explained to me that no, actually it isn't. It's your health, which is your ability to go to work and earn a paycheck. So if you think about it, think about someone's income over the next 25, 30 years. That is their most valuable asset. For a lot of people, that's going to be millions of dollars. So as a financial planner, I sat down thinking I was doing a great job for my clients. I was getting them life insurance. We had a retirement plan. But what was the one vehicle that I needed for that retirement plan to come to fruition? Is a paycheck. And unfortunately, I was letting that paycheck unattended. And kind of the way I like to phrase it is picture a $2 million bag of money, $3 million bag of money. That's your income over the next how many years? Just sitting out there on the sidewalk, completely unprotected. So obviously, when I realized that, I went back and I had to have this conversation with people. And then I started realizing no one was having this conversation. So there's so many people out there that are completely exposed. How are we going to pay our life insurance premium? How are we going to pay our health insurance premium if we get sick? What are the odds of getting sick? Well, here's what I'll tell you. 1 in 4 of today's 20-year-olds will have a long-term disability before age 65. But that number jumps to 43% for 40-year-olds.
That's crazy.
In other words, yes, almost 50% of people age 40 will have a long-term disability before age 65.
Especially younger people, me and my peers, we can easily get into a thought that, we're sort of invincible, right? Like we're not old. We're not going to get into disability. We're not going to need long-term. Like we kind of get that thought, like we really don't have that risk in our lives. But statistically, it's actually more likely than other things that we're more familiar with, like life insurance or homeowners insurance and different things like that. So statistically, it's actually something, no matter how early you are in your career or how late you are in your career, you really need to be thinking about. Interesting. So that kind of spurred the thought in your mind to get more into that world of income protection.
And I like to ask people a question. At the end of the month, how much of your paycheck do you not need? Okay. And then I'm going to follow that up with, okay, let's say tomorrow is Friday. You're receiving your last paycheck for 5 years. What is your plan?
Crickets.
Crickets, exactly. And then, and then quite honestly, I'm going to ask you, does that bother you?
I would imagine so. Yeah.
Absolutely. Yes.
Yeah. Yeah. That's a great way to frame it. Interesting. And so what are you doing now with Truluma? What's your role there?
So income protection is a lot like car insurance. If you're driving a sports car and you've got 3 speeding tickets, you're going to be going to one place to insure your car. If you're a great driver and you're driving a Toyota Camry, you're going to go to another carrier. Income protection is the same thing. I have pretty much every carrier out there at my fingertips, and my job is to place the client with the best carrier for them and their situation. Maybe some people have some health risks. Perhaps some people have more risky occupations. Optometrists, for example, are a great risk because if you think about the material and substantial duties of their occupation, it's a great risk for an insurance company as compared to a tree trimmer who has the potential of falling out of a tree, cutting their arm off.
Yeah.
So I'll take them to different carriers.
Got it.
And also, believe it or not, age plays a factor as well. Some carriers are good with older ages and some carriers are better with younger ages.
Got it. Yeah, and being a good risk actually is a good thing. It means you are in an occupation that's more favorable in the eyes of the insurer.
Exactly.
So if you were to just describe, and I guess the first thing I'll say is, as we get into the weeds a little bit more here, everything David and I are going to talk about is educational and it's general in nature. We're going to try to give you as much information as we can to help you, optometrists, make better decisions around your insurance planning and your income protection, or have more informed conversations with your advisors. But everything we're going to talk about is going to be general in nature. And so make sure when you're making decisions around these things, talk with your financial advisor, your insurance agent, making sure you're looking at your own situation and making decisions based on that. Don't listen to a couple of guys on the podcast when making the decision. But with that being said, let's dive into more details here. If you can describe what disability insurance is as briefly as possible, what is it and what does it actually do?
Here's what I'm going to say. It's a salary continuation program. In the event you cannot go to work because you are sick or hurt, we will give you a paycheck, typically tax-free, to help pay your bills during that time. The one thing I will tell you is most people think if they're going to be disabled, it is going to be an accident or some type of accident, whether it's a car accident, falling downstairs. What I can tell you is less than 10% of claims with the top carriers within the country are accidents that occurred. The majority of claims that we see are health conditions that come up. And the way I like to explain that is, how many people do you know that are 50 years old and take less medication at 50 than they did at 25? As we get older, health conditions come up, we get sick. The great news is what used to kill us now disables us.
Yeah, interesting. As healthcare improved, yes, we live through more, but we have ongoing disabilities that might hinder us from doing those other things. And to your point, as I was doing some research for this conversation, one of the stories I came across was a dentist that was cleaning out his garage. And I don't even remember where I got the story from, but he was cleaning out his garage. And as he's digging through old boxes and old things, stuff got in his eyes. And whatever got into his eyes was so bad that it permanently affected his eyesight. And optometrists may appreciate this. Maybe you've seen situations like this, but it permanently affected his eyesight so badly that he couldn't even perform as a dentist anymore. So that was a story I heard that was surprising to me, that you never know what really can take you out of the game, so to speak, when it comes to your income. And you had mentioned a few examples of numbers, of values of your lifetime income. And, going back to that question, yes, what is your biggest asset? Is it your 401k? Is it your optometry practice? Chances are, for most of us, especially earlier on in our careers, your biggest asset is your earning potential. It's your ability to work. It's your human capital. And I actually put some numbers to this because I was curious what that looked like. If you're an associate optometrist, just for an example, but if you're an associate optometrist and you're 30 years old and you are earning $130,000 right now, and you expect that to increase 3% each and every year, just a little inflation bump, and you're going to work for 30 years until age 60, right? So you've got 30 years of income starting at $130,000. If you were to add all of those years of earnings up and bring it all into today's dollars, that 30 years of earning potential would be worth somewhere around $3,700,000, right? That's substantial. That's as if you had a $3 million asset that was kicking off that amount of income each and every year. If you're a practice owner, let's say you're a 40-year-old practice owner, and you had, just to make the math easy, $250,000 worth of income coming out of your practice, and you were going to work until age 60, that 20 years of income, again, added up and brought into today's dollars, would be an asset of somewhere around $4.8 million. So your ability to work, your human capital, is a substantial asset. That's real money at stake. That's real money on the table. And that's not even including what happens to the value of your practice, separate from the cash flow, if you weren't able to work. So just wanted to put some numbers on that as examples, just to give you a framework of what does that actually mean to be your most important asset. So with that in mind, I want to talk about some key features to look at if an optometrist is considering buying disability insurance, which hopefully they will be, and they're weighing some options. Like what are some of the most important features to think about? One thing I wanted to touch on first, and something you mentioned, is the taxation of benefits, and that if you are paying for premiums with after-tax dollars, the benefit you get is going to be tax-free, generally speaking. If you are paying for premiums, let's say through a group plan at work, and your employer's paying for it, or if you're paying for it out of payroll and it's pre-tax dollars, then the benefit becomes taxable. So generally, it makes sense to pay those premiums with after-tax dollars so that you get that benefit tax-free. But one thing I wanted to ask you, David, is how do insurers calculate what someone's eligible for in a benefit? And I think a second question that goes along with that is how do they actually define your income?
Okay, so you're defining your income is going to be, if you're a W-2 employee, it's simply going to be, we're going to put that income in. and it goes into the system, and there's actuarial tables that determine the maximum amount you can make. So if someone's making $50,000 a year, they need almost all $50,000 to be able to survive. So they're going to see a higher percentage of income covered than someone, let's say, making $500,000 a year. And the way I like to explain that is, if you're making $500,000 a year, you should be able to survive on, let's say, $250,000 tax-free. So that's a 50% coverage, whereas someone who's in the $50,000 range may see closer to a 65, 70% coverage.
Got it. Okay. And what if you're a practice owner? Let's say many of the practices that practice owners that may be listening, they'll have a practice that's in many cases taxed as an S corporation, so they'll have a salary coming out of there as well as shareholders' profit. How does an insurer look at their income?
Well, one of the things we recognize as a business owner is that you're taking a lot of deductions. So many of our carriers will give you an enhancement of an extra 10 to 15% to help make up for that.
Interesting.
I do run into situations where people have a great CPA and they show almost no income. That makes things very difficult for us. But one of the things I want you to keep in mind is, once you get this coverage, in most instances, you're locking in your health, and there's going to be a pool of money that you can go after down the road. So if someone is writing off a lot of income, in future years, they could maybe not take that tax deduction, let their financial planner know. We go back, we increase the coverage and to make up for that difference, and now you're locked in.
Interesting. Okay. And how would that work for someone who is an independent contractor? They're really just looking at a Schedule C coming through, so they're just looking at net income on a Schedule C. How would they look at their income?
We're going to look at the net income. We put it into the system, and it spits it back out and says, this is what you qualify for. Now, something to keep in mind, when someone goes out on claim, odds are their bills are going to go up. They're not going to go down. You've got high deductibles, you've got doctor's visits, you've got medications that aren't covered, you've got travel time, depending on what the situation is, possibly physical therapy, possibly help within the home. So expenses go up, but the problem is we cannot insure you and make it better for you to stay at home than go back to work. So there is always going to be a loss of income. It just depends on exactly how we design the policy and where you are at income-wise.
Yeah, interesting. And you'd mentioned that in general, you're looking at replacing somewhere between 50 and 70% of your income, but the higher your income goes, the lower that replacement percentage is going to be, closer to 50%.
Correct.
Is there ever a situation where you can bring in multiple carriers to sort of bridge gaps that maybe one carrier won't cover?
Absolutely. We've got multiple different options. Also, sometimes people are doing traveling overseas to countries that are high risk, or maybe they're into some type of extreme sports. We have carriers that can cater to that marketplace as well. If you max out at one carrier, we can certainly bring in another carrier and they will coordinate together. If you have group coverage, definitely take a look at it. There are a lot of provisions in group coverage that leave you exposed. For example, if you receive any type of bonus, typically that's not covered. Also, something to think about, let's say you're in a car accident and you're filing a lawsuit against the truck that hit you. Typically, there's going to be a provision in there where the group coverage is going to hold back and not pay out until they find out what you're getting. Whereas individual coverage is going to pay right away as soon as you satisfy the requirements.
Got it. And in terms of length of coverage, I believe it's anywhere really from 2 years up until age 67, probably. I mean, what have you seen in terms of length of coverage that you can get?
Actually, I'm seeing a handful of carriers going to age 70 now, believe it or not.
Oh, wow.
We're working longer. But absolutely. And my answer to that is, what am I seeing? Typically, it's age 65 to 67 is what people are getting. But keep in mind when looking at this, there really isn't a right or wrong answer. We don't have a crystal ball. We don't know what your situation is going to be. Something is always better than nothing. Work it into your affordability, but I'll ask you two questions. if you knew tomorrow you weren't going to ever be able to work again, how much coverage would you want?
Yeah, interesting.
And I'm going to throw this out there because my second question is, most people are wondering, well, what does this cost? How much am I going to have to pay for this? Well, how much would you pay if you knew you weren't going to go to work after tomorrow for the rest of your life? But I'll give you a round number. Roughly 2% of your income. So this is the way I like to describe it. Picture sitting on the table in front of you, 3 quarters, 2 dimes, and 5 pennies.
Okay.
That's $1.
Okay.
Take 2 pennies away. Would you give up those 2 pennies to make sure you received the rest of the $1?
Yeah. Yeah. I think most people would take that bet, most likely.
Absolutely. And like I said, there are a lot of moving parts within these types of plans. My job is to simplify it and bring you to the best carrier. So we can peel certain things off that aren't important or things that we can do without. For example, there's what's called a catastrophic disability rider. And it looks just like a long-term care rider. Older people that take out these policies like to have that. So essentially, if you cannot satisfy 2 out of 6 activities of daily living, you're going to receive an additional benefit because it's a more severe disability where we have to bring people in to help take care of you. Maybe that makes sense for you. Maybe it doesn't. If it doesn't, then we take that off.
Yeah, interesting. It is good to know that all these different features we're going to talk about impact the premium in some way, and you can arrange arrange the policy in a way that's going to give you the best coverage for your situation, but also within what you can afford within your cash flow. And back to that window of coverage, you want to be able to cover your expected career length. You want to be able to cover your expected earning potential. So it definitely makes sense to get somewhere around age 65 or 67, depending on which carrier I guess you're looking at. And a question that comes up a lot is, how long do you really need disability insurance, or who really needs it? And what I would say from a financial planning standpoint is that you don't need disability insurance when you are truly work optional, when work is truly work optional for you. And what that means is that you've built up enough wealth and income so that you not being able to work or choosing not to work is not going to substantially impact either your day-to-day living or your long-term retirement security. So at that point in your life, whenever you have built up enough wealth and income to be truly work optional, that's when I would say, okay, you can consider letting that policy go. And I would say that's not retirement. You may be work optional before retirement. You may just want to continue working for love of optometry or continue running your practice. That's up to you. But that's usually the point where I'd say, okay, that's when it starts to make sense. Other than that, it definitely makes sense to have long-term disability insurance coverage. Anything else to add there, David?
Something to consider for those that have group coverage, especially for optometrists. What will happen if you want to leave and start your own practice, or maybe join another practice that doesn't offer benefits, and you are currently experiencing a health condition that would make you uninsurable? It's another reason to make sure you get your own personal plan. It can be a smaller plan, but what we want to make sure we do is lock in your health while you're healthy and you can still qualify for it. Keep in mind, we are all one doctor's visit away from being uninsurable and unable to obtain this coverage.
Yeah, that is an interesting point to keep in mind, is that if you have group coverage, it's a great benefit to take advantage of. But always keep in mind that either if you're not a part of that group anymore or part of that association, how will you have continued coverage? So something to keep in mind there. And so we talked about how to define your income. We talked about potential maximum benefits, somewhere between 50 to 70%, depending on your income and your the policy you're looking at. We talked a little bit about length of coverage. What are some other features that optometrists need to keep in mind as they look at these policies?
One of the things that you want to make sure is that you're covered as an optometrist. So, for example, let's say something happens and you can no longer be an optometrist, but you can go out and sell real estate. I'm going to make an assumption that you're an optometrist because you love the profession, you love the job, you love what you do. You would be a real estate agent if that's what you wanted to do. I want to make sure that when you get a plan that it's going to cover you as an optometrist so that you're not forced to go back to work in a different occupation. Now, if you choose to do that, that's great. You can certainly do that, but we want to make sure that it covers you as an optometrist. So just to give you an idea, some people will ask me about Social Security disability. The difference between the two is an individual plan will cover you in your occupation. Social Security disability, you have to be completely disabled and unable to perform in any other occupation, and you have to have no prospect of recovery. So it's permanent disability, unable to work in any job. With an individual plan, it will cover you as an optometrist, and they will not say, look, you know what, you can go over here and, like I said, you can sell real estate, or you can go to work at Starbucks, we're taking your benefit away. These individual plans do not do that.
Yeah, and that's what you're talking about is how they define disability, and the term generally that you're talking about is own occupation, and this is, you know, it's one of the most, if not the most important factors that you think about all of the time and education and effort and energy that went into becoming an optometrist, and this is the profession you love, and this is where your income potential is at. So you definitely want to protect that investment and all that time. And how would that work in practice? Is that a scenario where if someone can or decides to go work in some other job, like would they still get a benefit? How would that actually work in practice?
It's going to vary from carrier to carrier, which is why we want to make sure we get you with the appropriate carrier. But typically speaking, if you can no longer be an optometrist and you decide you're going to go out and be a top real estate agent, you will collect your full benefits and you can make as much money as you want selling real estate. So it's, in theory, you could make more selling real estate in certain markets than you were as an optometrist. The key is it's your option. It's what you decide is best for you and your family.
Yeah, that's interesting. Even if you decide to go into another field, you can still get that benefit there. That's important. What are some other features to keep in mind?
There's something called residual or partial disability. And the way I explain that is if you're out for, let's say, 3-4 years with some type of illness, when you start to recover, you're not going to jump up one day, go back to work and start working full time. There's going to be a gradual increase, or sometimes even a gradual full disability. So you'll start off, hey, you know what, I can only work half time. In that scenario, with that feature, you will receive, let's say, half of your benefit. So if you have a $10,000 monthly benefit, you're working part-time, you're going to receive roughly $5,000 a month in benefit. On the other side, let's say someone is going back to work and they're working their way up. So they come off full claim and they say, okay, I'm going to do 2 days a week. We'll do 2 days a week for however long. And then when you get to 3 days a week, and then so on, we'll build back up to where you're fully self-sustaining with your current occupation.
Interesting. So I'm just thinking about how your own occupation, how that feature works together with this residual feature. It seems like own occupation protects you if you cannot be an optometrist, but you can do something else. It would protect you in that
Correct.
scenario. And it sounds to me like the residual rider, this residual feature, protects you if you can be an optometrist, but you cannot work enough to get to the income level you were before disability. Does that sound like the right way to summarize that?
Absolutely. Yes, absolutely. Before I forget it, another huge piece and huge reason to do this thing is the future benefit increase option. If you are a 30-year-old optometrist, I can pretty much guarantee you in 15 years, you're going to be making more money.
Yep.
So if you're making $100,000 a year today for easy numbers, and you're making $200,000 a year 15 years from now, you're going to want that coverage to increase. If you are uninsurable, with most of these carriers, they have a feature where you can still increase coverage because you've already satisfied the requirement back when you took the policy out. It's called the future benefit increase option. I have one carrier that has a pool of money of up to $30,000 per month. So if you're just starting out in practice right now and you're not making as much, you get that policy, and every 3 years, we can increase your coverage to make up that increase in income. So if 3 years from now, instead of making $100,000, you're making $130,000, we want to take that additional $30,000 into consideration. We want to increase your current coverage. And the key there is it's regardless of your health.
Yeah.
So if you're diagnosed with something, as long as you're working, we can increase that coverage.
Yeah, and that works in that they would submit income, W-2s or tax returns to the company every 3 years,
Correct.
essentially. And there's also a
Just
benefit.
verification.
And there's also a benefit that would protect you from inflation, even without having to prove your income every 3 years. Is that correct?
Absolutely. So it's called a cost of living adjustment, or in other words, they call it COLA in the industry if you're talking to someone. The way COLA works is, let's say you're 40 years old, you become permanently disabled and can never go back to work. Well, today, right now with what we're going through, it's a perfect example. There's inflation. So $10,000 a month that was good enough today, 5 years from now may not be enough. So you're going to receive basically a cost of living adjustment automatically every year. Typically, it's up to 3%.
Got it. Yep, that's definitely important. Ways to protect your coverage and your income both before disability and after disability through inflation. One thing I don't know, did we talk about the waiting period?
We did not. And so essentially what the waiting period is, it's a time that you have to satisfy while being disabled without a paycheck. And we have them as low as 30 days up to 360 days, and anything in between. Typically what I see is a 90-day waiting period. People usually have enough in savings, enough that they can tap into to get by for those 90 days. And then after that, you start receiving your benefits.
Yeah, everything you said there is important in that I just remember from running all those illustrations myself back in the day that 90 days usually was sort of that sweet spot where the premium was okay and it was a short enough time to make sense.
Mm-hmm.
And that's sort of your deductible. You've got to wait those days out before you can collect that benefit. And it's important to make sure that you have enough liquidity in your household. You have an appropriate emergency fund, rainy day fund, whatever you want to call it. But you have enough liquidity in your household to withstand at a minimum those 90 days. Usually recommendations somewhere between 3 to 5 months. Depending on the household. So you want to make sure this is another example of why having enough liquidity, just having enough cash set aside in savings, is important to make sure that you can cover that gap if something were to come up. What are some, well, let me ask you this. Let me back up and say that if you were to rank all these different features, like if you were to say, hey, this is the thing you really need to think about first, and then number 2, number 3, like what would that lineup look like for you?
It would the number one, the foundation of any solid financial plan is going to be your paycheck. A salary continuation program is essential. I mean, think about all the things that your paycheck pays for. It's your cell phone. It's your deductibles for health insurance. It's your health insurance premium. It's all your other insurances, your cell phone bill, your cable bill. Your paycheck is the foundation of everything that you do. I would rank that as the number one, and not because it's my specialty. I don't think anybody can argue against that.
Yeah, that's definitely true. The paycheck allows you to basically do all the other things you're planning for. And then in terms of if we can focus in just on the features within the policy itself, we talked about all these different things from your own occupation, from the definition of disability. We talked about the length of coverage, the amount of coverage. Like, what are some of the top priority, the most important of those features to make sure that you're focusing on in the policy?
Boy, it's really going to depend on the person's individual situation. But I would say number one, get the most coverage you qualify for. At the end of the day, we know that we don't have a bunch of expendable income at the end of the month. So, look at what you don't need. Is it 10%? Is it 20%? Well, good news. You still need the maximum coverage because you're still going to have a 10, 20% loss of income, even with the most comprehensive plan. So you want to make sure you get the coverage. I would say you want to make sure that you have residual, and you want to make sure that you have future benefit increase options. That is going to be a basic plan that will cover the majority of people out there. From there, we can start adding in other features that you think are important as they fit your budget. And I want you to keep in mind, there isn't a wrong answer other than no, I don't want to do this.
Yeah.
So think about this.
Yeah.
You're going car shopping, and you walk on to, I'm going to say, the Maserati dealership, and you look at the price tag of a Maserati. Would you say, I can't afford the car and take the bus to work? Or would you go back and you would find something else that was more affordable, that fit in your budget, that would make more sense?
Door number two.
Absolutely.
Yeah, that's definitely true in that we can put together our favorite lineup here, right? We can pick out all of our favorite best features and put it all into our dream policy. But the reality is, if there's an issue with the budget, or if we need to scale back, you can start to peel away or to adjust all these different levers and put together a policy that fits for you. One thing I wanted to ask you, David, is many of the listeners may have group coverage, for example, with the AOA, the American Optometric Association. And how would an individual policy work together and coordinate with that group policy? How would those two work together?
So what we would do is we would look at what that policy looks like. Number one, you want to be well educated and well informed on the features and benefits of that particular plan. Does it cover you as an optometrist for your own occupation, or does it have a clause in there that says your occupation for 2 years? In that scenario, it would mean if you couldn't be an optometrist for 2 years, after that, if you could do something else, you would lose your benefits. But typically speaking, if there is coverage in force, whether it's group or other personally owned, we're going to stack on top of that, and we're going to take that other coverage into consideration. So it will basically offset dollar for dollar for what you qualify for.
Got it. So first would come that group benefit, and then the individual policy would cover the gap to get to that roughly 50 to 70% income replacement.
Correct. So if someone is let's say you're a W-2 employee working for a corporation and you have a group plan, we're just going to cover the gap from what the maximum of that group plan is to what you qualify for.
Got it.
And again, the key part of that is, one, we're closing that gap in the event you have a disability, and two, we are locking in your future insurability. The two most important things that we can do.
Yeah, that makes sense. And let's talk about underwriting now. And what are some of the different factors when someone's applying for coverage and it goes to the underwriter's desk? What are some of the different things that underwriter is going to look at that affects the premiums of that policy?
They're going to take a look at your medications, your medical history. If you have anxiety is a big one right now. So if someone's taking medications for depression or anxiety, the underwriter is going to take that into consideration. In that scenario, you might see an exclusion, what they call a mental nervous exclusion, where everything is covered but an anxiety-triggered disability. So if you're something happens and you hurt your neck and you can't go to work, you're still going to be covered. If someone has a pre-existing condition, maybe a chiropractor, and they go and they have a back issue, you'll see a back exclusion. The good news is, like with something like that, if you're in a car accident and you break your back, that would be covered, but random degenerative back disorders would be excluded. Don't let that scare you away, because we already know that that's an issue, but there are a ton of other things that can occur. And the way I like to explain that is, think about taking out a sugar packet, opening it up and dropping it on the table. Take out a couple grains of sugar. Those are your two pre-existing conditions. The rest of that pile of sugar are health conditions that can come up that you're unaware of, that you don't think you'll ever get.
Interesting. Yeah, that's so pre-existing conditions is definitely something. You've mentioned already your occupation, and fortunately optometrists are in among the best occupation class, so that's good. Gender, I believe, if you're a male or a female, has an impact on that as well. Is that right?
Absolutely. Yep. Females typically are going to be a little bit more than males, just because of the way the claims have gone. But like you said, optometrists are excellent risk for these carriers. They have excellent experience with them.
Got it.
The other thing that we have, if you have several people in your office, we have what's called a multi-life discount with many of these carriers. And basically the way that works is females, if you have 3 or more people that take out a policy, females are going to receive a permanent discount, I'm going to say in the 30 to 40% range, and males are about a 20% range. So it's a great way to do like a bundling discount there. The other thing is, if you actually work for a large corporation, we already have discount programs available there. For example, Costco, we have a great discount program there that we will be able to front you in the event that you decide you want to move forward with something.
Yeah, interesting. Always ask about potential discounts that you can get for association discounts, group discounts, different things like that. And one other thing that's going to impact it, as David mentioned already, is your age. Just like life insurance, the earlier in your career you're able to get a disability policy, the lower the premium is going to be, all other things being equal. And so it definitely makes sense to purchase one earlier in your career when you can afford it. We've talked about different ways that you can adjust the benefit to keep up with your income as it grows, because it will definitely grow throughout your career. And another thing that will do, as David mentioned, is it will protect you from other pre-existing conditions that come up later on in your life. So generally speaking, the earlier in your career you can get some income protection coverage, it makes sense to do that. One thing I want to ask about was that besides pre-existing conditions that come up, what are some other typical, like, general limitations that you usually see in a policy? If from memory, looking back, different things like mental nervous limitations, like what are some things you'll usually see in a policy?
It's honestly, it just comes up, and it's part of our negotiating process with it. Maybe if you had a history of pregnancy complications, you may see a pregnancy exclusion. It really just depends on what your personal situation is. I mean, everybody has their own situation, and it's if you get with the right advisor, the right planner, they'll be able to help navigate through that.
Got it. Okay. So we're talking a lot about personal disability policies and how that impacts the individual. I do want to talk about practice owners, because there are, practice owners. You on one hand have a household and a family to protect in these scenarios, but you also have a business, and you have a world of other considerations to think about when it comes to risk and managing risk within the business. So what are some things that practice owners should be thinking about outside of that individual benefit when it comes to disability?
Yeah, that's actually a great question. Okay, first piece is if there is more than one owner in the business and it is a partnership, do you have a buy-sell agreement that dictates what will happen in the event of a disability? The majority of buy-sell agreements that I have run across do not have that. So if I'm an optometrist and I have a partner who's out, they're out for a prolonged period of time, how long do I want to cover the additional duties that other optometrist is not able to do before I turn and I say, listen, Bob, you aren't going to come back. Let me buy you out of the practice. So there's two keys there. Is there a clause within your buy-sell agreement that stipulates those conditions? Two, has the practice been valued? What is the valuation of the practice? The worst time to figure out what the value of your practice is when you have to buy out one of your partners, okay? I'm going to tie this up with what's called a disability buyout program. Where are the funds going to come to buy out your business partner? Right now, we're in interest rate environments are uncertain at best. Do you want to go out and take out a loan? Do you want to tap into one of your assets? Or would you rather pay pennies on the dollar to have what's called a disability buyout policy, where they have a triggering event with a set dollar amount of money that the partners agree on?
Yeah, that's a great point, and that can be an entire episode conversation on its own. In managing the business risks within two co-owners or two partners, if you do have a co-owner in your practice, definitely make sure that you have an appropriate buy-sell agreement, making sure you're working with your financial planner and your attorney to make sure that's written appropriately. And depending on which article or consultant you're working with, there are several Ds. Usually it's several Ds to think about in that scenario. There's death, disagreement, divorce, dissolution, and then one of those Ds, which are very important, is disability. And you want to make sure that even though those scenarios, those triggers are spelled out in that agreement, you know how that's going to be funded, just as David mentioned. And of course, one of the most efficient ways to fund those triggers is going to be insurance. And you need to think about, of course, in death, there's life insurance, but also in disability, there's disability buyout insurance to think about as well. So I appreciate you bringing that up, David. What are some of the other things that owners should be thinking about?
Well, if they have recently purchased their practice, there possibly is going to be a loan or some type of repayment schedule.
Yeah.
Well, if you're not coming in and you're not seeing patients, the money's not going to be coming in like it was. So there's what's called a business loan protection policy, where you can take that out and it covers that loan. So you don't have to worry about defaulting on your loan, losing your practice, losing everything that you put all those years of hard work into. So you have a business loan protection. Another key piece is what's called overhead expense. If you're out for, let's say, 6 months, 9 months, not seeing patients, the money's not coming in, are you going to let your staff members go? What are you going to do about the lease that you have, any equipment you have payments on? I, for one, have been going to my eye doctor for 20 years. How many times, if my eye doctor wasn't there and that office was closed, how many times would I have to go to a different optometrist before that relationship is gone? So that's kind of like give you a scenario. Let's say you're an optometrist, you've been established, you're there 10 years, you've got a great practice, you become disabled. The doors have to close. 5 years later, 3 years later, you come back. Where are all your patients? You're starting back at ground zero. So an overhead expense policy is going to pay those fixed expenses. They're going to pay your insurance premium. They're going to pay to keep the lights on. They're going to pay your employees to be around, so that when you get better, you have something to come back to. And if you don't get better, you have something to sell.
Yeah. So I want to ask a few questions on those. On the loan coverage,
Yes.
does that coverage only last as long as the term of that loan? So if it's a 10-year practice loan, someone's either cold starting a practice or buying into a practice, maybe they've got a 10-year loan. Would it only cover based on that 10 years?
Absolutely. Correct.
Okay. And some lenders, for optometrists listening, some lenders will actually require that you protect essentially them from you getting into disability while that loan's on your balance sheet. So something to consider there. And in terms of the overhead expense policy, will that allow a practice owner to then replace themselves and go and hire out another optometrist?
Absolutely. And that's really what we see a lot of times is we bring someone in to help out with the practice. Now, it could be someone younger starting out, receiving a salary. There's going to be a lot of different structures, and there will be an offset based on what that person brings in. But once again, how much of a loss do we want to see within this practice? I think we want to keep it as close to whole as possible, so that when you come back to work, you're starting right where you left off.
Yeah, and how long do these policies typically last? How long is the benefit?
Typically, we're going to see a 2-year benefit on the overhead expense, something along those lines. Again, we can tailor it. There's going to be other directions that we can go depending on your situation, but typically that's what we're going to see. And if you've been out 2 years, then things are going to change. But at least it gives you time as well to plan ahead and have a plan, whether it's an exit strategy or how we're going to structure this business.
Interesting. Yeah. And I guess in the short term, if something happens in the short term for practice owners, you definitely want to make sure you have enough liquidity there to cover, at least a month of your expenses minus your salary as a practitioner. 1 to 2 months there to cover short-term needs, but definitely if you're potentially going to be out, I mean, think about what would happen to your practice if you weren't there. Obviously, as David mentioned, where the patient's going to go, it's very likely the value of your practice is going to drop pretty rapidly if you aren't there to serve patients. So to protect the value of your practice, this is something to consider. And like you said, after 1 to 2 years, you probably have an idea of whether you're going to be able to come back and whether it makes sense to sell a practice or to just move on. So thank you for that. That's really great to know. Anything else that practice owners need to keep in mind?
Actually, as far as financial planning, there is another key piece that I like to talk about, and that is called retirement secure. And basically what that is it's an insurance plan for your retirement contributions. And kind of the way I want to explain this is think about when people save the most for retirement. Not really in their 30s, right? Because we're paying off our practice, possibly having children, buying our home, paying off student loan debt. Start getting into your 40s, you start saving a little bit. Now, let's say you're getting into your 50s, you say, I want to retire someday. Retirement is right there. I need to really start putting a lot of money into my retirement account. What would happen if you were disabled from age 55 to 60? What happens to your retirement contributions? What happens to any matches that you would possibly see? What about like market loss? So what we have is we have a policy that will put up to 15% of your income into an account that is just like your 401k. So your financial planning, that nest egg you anticipate having at age 65, 67, whatever age you're going to retire, it will still continue even though you're not working and you don't have the additional funds to continue to fund that account.
Yeah, that's an interesting point, and that, you know, you get into your 40s and especially even your 50s, you're not only often hitting the max on your 401k, but then you've got those catch-ups in both the 401k and IRAs. You've got potentially cash balance plan if you're a practice owner. So there's a lot of savings that happens. That definitely makes sense. How does that actually work? Is there money put into a trust on their behalf, or like how does that work in practice?
Absolutely. There is basically that 15% of your income is going to be put into a trust on your behalf. Once the money goes in there, it is your money. So if you come off of disability and go back to work, that's just going to become part of your portfolio. If you don't, then you're going to have distribution options at certain ages or for certain triggering life events, like a hardship. You could get into it as well. But what I want you to keep in mind is, let's go back to what we started with in the beginning. What are the benefit periods that we're seeing? How long does this coverage last? So I'm going to give you a scenario. Let's say you go out on claim at age 50. You have a disability policy that covers your own personal expenses till age 65. What happens to your retirement contributions during those years? Traditionally, they're going to stop. What are you going to do on your 65th birthday when you receive your last disability check? Under this scenario, you're just going to tap into this additional bag of money and use it in retirement, just like you would have your 401k or any other retirement vehicle that you have.
Yeah, interesting. And how is that taxed? Is it taxed like a 401k where distributions or withdrawals are, is that ordinary income?
It's actually, it goes into mutual funds. So it's going to be taxed basically like a capital gains type of situation. Okay. So it's a little less than ordinary income at this point.
And as that's building, would the optometrist be paying taxes on interest and dividends throughout the years, similar to if they were just investing in a taxable brokerage account?
Absolutely, yeah.
Okay,
they can be.
Got it. Okay, that makes sense. Thank you. Anything else that I just forgot to ask about, or anything else you want to add in terms of just income protection? Because I know we touched on a lot here, but anything else you want to add?
Here's what I would say. Most of the financial advisors and financial planners that I work with and I talk to don't talk about this because there are a lot of moving parts. Do not allow yourself to get confused with the moving parts. Find someone that can break it down for you and really simplify it. Think about your homeowner's policy. It's how many pages long. If they're going through and it's taking hours and hours and they're explaining it to you, back up. Start off with it very, very simple. How much do I get? When do I get it? And how long do I get it? Are going to be the main items to focus on. From there, remember the future increase rider, residual, and a benefit as long as possible would be my recommendation.
Got it. I love that framework. I think that really makes sense. Really simplifies things in a way that I think everyone can understand. And this is important, as we mentioned throughout the conversation. Risk management in your life is important. It allows you and gives you the freedom to then focus on diverting dollars towards those things that are usually more exciting to people: building wealth, investing, buying homes, different things like that, spending your money. So, one of the things I often hear is that, what if I never get a disability, and am I just wasting my dollars putting money into this policy? And two things I'll say to that is, number one, you hope you never use this policy. You do not want to get disabled. Like, this is something you hope you never turn to and use. It is protection in a worst case scenario. So that's the first thing I'll say. Number two is that even if you even if you do not become disabled and you do not use the policy, the dollars are not wasted. Taking that risk off of your shoulders of this financial loss, of lost income, taking that risk off of your shoulders and transferring it to an insurance company, that's meaningful. That risk transfer means something. It's worth something. So every month you send in your premiums, and not to make it sound like we're pitching the policy here. I actually don't sell insurance anymore. But every time you're paying that premium, you are paying for another month of transferring that risk off of your shoulders onto an insurance company. And for me, that's meaningful and that's actually valuable. There are those financial risks in your life that are not probable, even if they're unlikely, but can have a substantial effect, catastrophic effect on your finances. Those risks are the risks that usually make sense to insure. And that's what we're talking about here. So with that, David, unless you have something else to add there, I want to ask you, how can people follow you, get to know you, learn more about what you're doing?
Well, if you're on LinkedIn, I'm on LinkedIn, David Bennis, Bennis. My email, if you want to email me, is dbennis, Bennis @Truluma, just like it is behind me here.
Gotcha.
TRULUMA.com. And of course, you can always contact me on my cell phone, honestly, at any time. If you have questions, you want clarification, hey, how does my policy look? What do you think about this policy? What should I be aware of? I'm completely independent. I will tell you exactly how it is. My cell phone is 916-600-4746. I'm located here in Northern California.
Perfect. Well, I will put all that information in the show notes. David, I really appreciate you coming on and talking about this today. For the listeners, appreciate, again, you listening and taking the time to learn a little bit here about protecting your income from disability. And we will see you on the next show. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.